Good afternoon, everybody. This is the first time we are doing this particular program, and quite a lot of new work has gone into what I'm going to present today. The title is Mutual Funds or Stocks. This is something that a lot of people ask us. The two or three the most common questions people have are: should I go by the fund route or by the stock route? Which stocks to buy and which funds to buy? Obviously, that's what everybody would like to know. And the third thing everybody wants to know is, irrespective of where the market is it a good time to invest? When the market is down, they're very terrified. So the question is it a good time to invest? The sub-question hidden inside that is that, will the market fall further? When the market goes up, is it a good time to invest? The sub-question hidden inside this, it's already gone up so much. Would I make a mistake jumping in now? So no matter where the market is, if it's not going up, you would see headlines in Economic Times saying gold has gone up 10% in the last 3 years. Stocks are down. So those things play on our mind and we say, is it a good time to invest? So no matter where the market is, if it's crashing, we are terrified. If it's sideways, we are not hopeful. If it's already gone up, again, we are terrified whether they're going to make a mistake or not. As I keep saying, we should avoid all of these issues because timing is not very important unless you really want that extra bit of returns. For an average person, it's fairly easy to choose to select a path which way to go, and we have sort of sharing this particular direction for a long time, for 5 years now, in different manner, different forms. I've been sort of explaining what is to be done. This presentation is quite interesting and quite new, and we are very happy to share this with you for the first time in Mumbai. We've done a version of this in Pune a few weeks ago, but I've improved quite a bit on that subsequently. I shared with you what investors normally ask, and this is what they normally do. Okay, here is a chart of Sensex. I'm going to share with you now a bar chart of mutual fund inflows. There's a very clear pattern over here. Anybody who's watching it very closely would know that I've already circled two. Anybody watching this chart would very clearly see that I've circled two areas where the maximum amount of participation. Anybody looking at this chart would know that the investors have participated the most at a previous market peak, which is over there. And then when the market started moving sideways, they have sort of got out in a hurry, or they have sort of kept on selling. What typically happens is that since bulk of the investments come in fairly late in the bull market, there's a lot of nervousness when the market falls, and then when the market starts rising, get me out at any price kind of a syndrome takes over. I've spent 4 years and I've got no return, so I want out right now. Once that happens and the market moves a little sideways, it's time for the cycle, the growth cycle to kick in, either investment cycle or a growth cycle or some good news. It's very simple, that you have a series of bad news and you're going to be followed with a series of good news. That's the way life is, and that's the way market is. So in this case, it was huge expectations. I'm not going into the details of whether those expectations are correct or incorrect, but huge expectations around the new government and the market sort of shooting up. In this case, once the market goes up, huge amount of investments started coming in. I read the other day in the paper that in the last few months, the investments that are coming into mutual funds in few months itself is equivalent to last 10 years of investments. I'm not sure if this figure is correct or not, but you can add up all the bars. It looks incredibly like a tide flowing into the market after the market has already gone up. There's a lot of explanations for this. There's a new class of investors I read in Economic Times who would not sure that they can buy stocks directly, which is a topic which is relevant to us. They lack skills time, experience required for investing in shares. They want to rely on professional fund managers. All this is valid. This is valid at any time. But the question remains, what are they buying? Very interestingly, and this is a point that had become very important in the US many years ago, and this is going to happen in India too. The number of equity mutual funds are 352 already, and they'll keep increasing because it's very easy to launch a new fund, especially very tempting to launch a new fund when the market has gone up, because people want to invest in, for 10 rupees in a new fund, irrespective of whether the underlying shares have gone up or not. So a lot of closed-ended funds came up, and a lot of new NFOs have started coming to the market right now. So you can very well be certain that this 352 is slowly going to inch up to 400, 450, 500. In the US, the number of funds are more than the number of stocks. And we've already reached a situation where the number of funds are more than good quality stocks, at least. There are 6,000 stocks listed, but who cares about 6,000 stocks? A majority of them do not earn a return on its shareholders' capital that would justify our investment in them. So if a bank is lending to businesses at 12%, 30%, or 14%, if a company is not able to earn more than that, it is doing a very poor job. And companies that are earning more than 12, 13% are very few in number. There's not more than 200. I've extended my list to 11%, and I get a figure of 350 stocks or so. Let's say 300 quality stocks and 352 mutual funds. The question and the problem and the issue remains, how would you choose? In principle, there's no difference between stocks and funds. A lot of people try to tell you go by the fund route if you don't understand stocks, which is okay, fine, which is absolutely valid. But I've already posed the first question. If you can't choose stocks, how would you choose funds? And vice versa. But some amount of technical knowledge is definitely needed. It's not so easy. Both are volatile on a day-to-day basis. The reason we get to know and discuss more about stocks is because stocks, there is a ticker for stocks. There is no up, down, minute to minute, 5% up, 3% down kind of thing on NAV. NAV is calculated at the end of the day. You don't even get intraday NAV. I mean, you can calculate if you want to, but it's madness for any mutual fund investors to even ask to calculate intraday NAV. Whereas stocks are being discussed every second, and there is a ticker, as I said, which keeps running. So we get to feel as if the stocks are much more volatile and mutual funds are much more safe. They are not. Now, both fall. When they fall, both fall very sharply. And I just happen to sort of ask these questions, and I come up with a very interesting answer. Here is a chart of a fund or a stock, and the next chart also of a fund or a stock. We don't know which is which. They all both look similar, isn't it? In fact, the first one looks more like the stock, and it isn't. That's HDFC Top 200, and the second one is a blue chip company of India, which is Infosys. Forget about which has gone up more or less or whatever, but they look very, very similar. When they fell, they both fell. When they went up, they both fairly went up in tandem. Funds are wonderful products, and there are lots of interesting features in funds which we cannot ignore, and which is very, very important for an investor who is possibly investing for the first time, investing less, and so on. And here are the reasons. You have absolutely no time to even look at stocks. Very often it happens that we get a email from somebody who is 60, right? Moneylife Foundation member or magazine reader or whatever. 60, 65, 70. Not only is he managing his own money, but he's managing the money of his son or a daughter as well. And they're so busy, they don't even know where the money is. They just are interested in earning and possibly spending and partying. So in a situation like this, where you have absolutely no time at all, which is what is happening to a lot of young people, funds are the right route. No interest. I completely sympathize with this. There are 20,000 more interesting things in the world rather than figuring out NAV and return on equity and, company management. Finance is boring. There's a reason why it's boring. It's sort of the best of finance is unexciting, and people want some change every day and so on and so forth. No one to trust. The other day there was a lady in our seminar, and she kept on repeating, wonderful presentation, great, but I don't know whom to trust, after having come to Moneylife Foundation. So I said, you won't like the answer I give, so I won't give that answer. Sure, I sympathize with this. 50 people may be trusting me, but what about the 5 lakh people who are outside? They don't even maybe know about me, or they can't attend a conference seminar like this. And if you've gone through one cycle, which is where you invested in 2007 and you sold at 2010, having got disgusted with negative returns, that is losses, being nicely put, or meager profits, you don't even trust yourself. That nobody would believe that, nobody would admit that, but in a heart of hearts you feel that, I don't know, this is not for me. And this is a very important point. For an average person may just not have the money to invest in stocks. And this is most often, this is something that is not highlighted by the media. It's a very, very practical and important issue. To invest seriously in stocks, you need to sort of diversify a bit. Say you need to invest in about 10 or 15 stocks. May not be at the right time, but fairly closely to each other. If you stay exposed to one stock, you're taking a huge risk. If something goes wrong with that company management, or the external environment, or something in that sector, it's not done. It's a very foolish thing to do, just to buy one stock. To buy 10 stocks, today all high quality stocks are in 4 digits. Whether it's HCL, or whether it's Infosys, or whether it's TCS, MRF is some 36,000 rupees or so. It's a very good quality stocks. He refuses to either split or give bonus, and he's been like this for the last 25 years. I know, Mr. Mapillai. And so the stock is valued at 36,000. If you buy one stock, you need 36,000 rupees. I mean, that's an extreme example, but any good quality stock, Nestle is 6,000 rupees, for instance. This problem is just going to get worse and worse and worse, because India has this funny concept of par value. It has to be at least 1 rupee. So you issue a bonus and you do a split, and it becomes 2 rupees, and then it becomes 1 rupees. Good quality companies keep growing. When they grow, they earn more net profits. When they earn more net profits, the share price goes up. So 1 rupee stock can become 6,000 rupees someday. What happens then? 6,000 can't be, you can issue another bonus maybe, but you can't split the stock anymore. So at some day, Indian government will have to think in terms of not having a par value, but that's for them to decide. But net problem is that if you want to buy 10 stocks, you need 50,000 rupees maybe, or 40,000 rupees to start with, if you have to diversify and buy quality stocks. And in a situation like this, a lot of people look around for, double-digit stocks and stuff like that. And that's risky, because you're not focused on quality, you're focused on the number. So for all of these reasons, including the fact that it's your first day investing and you don't want to take a chance, or first year in investing, mutual funds are absolutely fantastic, wonderful. I'm all in favor of them. But a lot of people come up with reasons to invest in mutual funds which are not correct. For instance, for fund industry itself says that we offer you a lot of choices. So you can choose between sector funds, contra funds, target date funds, international funds. I'm just giving only a few examples. There are hundreds of them. Like ice cream or shampoo flavor, they just hundreds and hundreds of different kinds of. It's like sold like a consumer product with different variants, like a Dove soap or a Lux. Now, we don't need all those variants. They're not good enough. They're bad. In fact, international funds, we were against. We were proved right. When we launched the magazine, in the second issue, we wrote, don't buy contra funds. UTI was advertising contra funds in that issue. They stopped all advertisements thereafter. I didn't even know that they were advertising contra funds. But contra funds was something that was very popular at that time. Everybody was launching. There's no meaning to contra funds. You buy good stocks and hold in a portfolio. What contra are you playing? So, sure enough, they have not done well. sector funds worse because you're fully exposed to just one sector. It goes down, you had it. I mean, the whole idea is to diversify, not try to be over smart and guess now automobiles is going to do well, or FMCG is going to do well, or banking is going to do well. Nobody really knows. Even the fund managers don't know, which is why in a large cap fund they are diversified across so many sectors. If they knew, they'd be concentrated within that large cap funds in specific sectors. People also say, unlike Satyam, human mind always looks for one negative example and tries to blow it. So you ask people to buy stocks, they say, look at Satyam, as if there is no other example in the world. So, unlike Satyam, funds don't go bankrupt. Okay, funds would have gone bankrupt in 2008 but for SEBI's strong intervention, but that's a different story. That's no reason, because your whole objective, if you're not buying funds, is to buy good quality companies across sectors. Several of them. One goes bankrupt, maybe Nestle goes bankrupt, who knows tomorrow. But you would have invested in 14, 15 others, and hopefully your entire portfolio is not going to go bankrupt. Liquidity, you can redeem anytime. It's not such a major issue according to me. You can sell the stock anytime as well. Professional management, in principle, yes. But I'll have a chart subsequently to say mutual fund industry as a whole is run very professionally is one thing. To take advantage of that is quite another matter. I have no doubt that they intend to be very, very professional, but the performance is a different story. For beginners, I said funds are the right route. No need to select funds. No need to select stocks. Buy index funds and Nifty ETF, for instance. Now, what kind of returns would you have got if you did this? Nifty, this is total return index. There's a difference between Nifty that you see, which is only a price change. But if you bought the shares of the Nifty companies, you would be getting dividends as well. And you would be reinvesting the dividends, hopefully. So the return that you get not only from the price change, but from the dividend as well, is called total return. It is capital appreciation plus dividend, both tax-free. Nifty total return index would have given you almost 21%. This is annualized return from June 2003 to May 2015, which is about 12 years. 12 years, 21% compound. This is one of the great periods of investing. This is not going to be replicated in future, so don't go by this. But you would have a choice of buying Nifty. If you bought Nifty ETF, you will get a return which is close to total return index. Or you could buy ICICI Prudential Index Fund, which came pretty close to the TRI, UTI Index Fund, BSL, and so on and so forth. As you go down, the returns are a little different from the index, because either they try to optimize, which means instead of getting fully invested with Nifty stocks, they try to keep 15% in cash. They say that if there are redemptions, we have to pay out and so on. So the returns will vary. Some of them, like LIC Nomura, even buy non-Nifty stocks. So not only do they try to time the market, they buy non-Nifty stocks, and the results are pretty bad. So if you're buying index fund as a beginner, it's wonderful. Buy Nifty ETF or buy one of the top 2 index funds, and this is roughly has been the return for the last 12 years. It will not be as good in future. We will certainly get about 12 to 14% over the next decade or so, all tax-free. And the beauty about this is that you just buy that fund and forget about it. You don't need to change. You don't need to pick stocks or decide on which funds and so on. For those who are interested, choose from top performing funds. That is only large cap and only mid cap. The large cap includes equity, diversified, multi-cap, all different flavors and things like that, and a little bit of mid cap. So you probably would have 30% or 40% mid cap and the rest in large cap, and that's it. Nothing else is needed. You need to choose between this, of course, but as a category, eliminate 90%. Not 80-20 principle. 90-10 principle is in finance. 90% are irrelevant or harmful, or both. Only 10% is good. You need to pick from there. Sorry. Yeah, multi-cap, flexi-cap, or whatever to say. 10-year returns of top 5 funds. I've just given it by way of what kind of returns you could possibly expect. These are based on historical performance. It says nothing about the future performance, but usually funds which are in the top 25 percentile, top 25% of the funds usually tend to keep performing or staying at that top level. So while it's very important for you to decide which one, if you choose, if there are, let's say, 100 funds, and if you were to choose between top 10 of those, at least 6 or 7 of those will keep repeating. They are the good boys in the class. They are between first, second, third. They are not going to go down to the bottom of the pile over a period of time. Don't choose a period like a year. It doesn't matter. Within a year, yes, HDFC may underperform or Reliance may outperform, or all of these things are going to happen. Take any reasonable period. And by reasonable period, I mean 5 years to 7 years. Any rolling 5-year to 7-year period, the good guys are going to always be on top. Somewhere on the top. It's not, as you can see, 22.75, 21.99. It's hardly any difference. Okay. Next time, maybe Birla Sun Life frontline equity is number 1. So it's somewhere there. Very easy to find out. Go to Money Control, Value Research, choose a period. Don't choose anything that's less than 5 to 7 years. 7 years preferably. See who are the top. Choose any other period. Do this over 4-5 periods. See the ones that are coming more frequently on top, and that's your good fund. That's it. Nothing else is needed for you to sort of choose. If you want to more than this, the cost benefit is not going to work in your favor. You're going to spend more time, and what you're going to get out of that is not going to be significantly better. You're not going to discover gold. You only discover these funds. These are the schemes that keep coming up here and there. The best thing you can do is that, having selected 4 or 5 of these funds, just go into the portfolio and see if it's possible. Spend a little more time to see that the portfolios are not similar. I'll give you a wonderful example of HDFC top 200 and HDFC, and I'll show you how to do that. Ensure that the portfolios are, ultimately they'll be common stocks. Again, in market, everything is a question of approximation and probability. There is no hard and fast and pinpointed rule and conclusion anywhere. So it's not that though there is Infosys in 3 different funds, doesn't matter, it's okay. Question is whether 50 to 60% of the stocks are similar or not. Within one fund house, you will find that. So if you choose Reliance, and if you choose ICICI, and if you choose HDFC and UTI, this, I'm not recommending them, by the way. I'm just saying that I have noticed that their styles are different. So it's most likely that you're going to have different kinds of stock, at least 25 to 30% in each of these funds. Now, that's for those who want to invest in funds. And I've explained this multiple times. All of the other details that you need to know are all there in the videos which I've put up in YouTube. Now I'll move to the issue of whether to move to stocks and why. 2 of the biggest issues that I have about funds are costs and returns. And this is a central point about investing. Are you spending too much money to maintain that flat of yours so that your returns go down? Are you going to get enough of returns from that flat to justify spending that money? That's on real estate. Same thing about stocks. Mutual funds charge you 1.9, 2.3, 2.7, 2.8. It varies every year, whether you make money or not. So if you put them on, give them a lakh of rupees, you're going to be charged 2.8% of that every year, or 2.3% of that every year. The fund is very large, the charges are a little less, whether you make money or not. This cost drags down the returns. Let me explain how it works. Now, this is the growth of a 10 lakh portfolio over 5 years post cost. Okay. Between a stock portfolio and a mutual fund portfolio, I have assumed returns which are identical. And yet, if you notice, the stock portfolio has hugely outperformed the mutual fund portfolio or the same rate of return. Doesn't matter what the rate of return is. Maybe it is 15% or so. You would notice something quite interesting. There are 4 legends there. Stock portfolio, how much is the value? Mutual fund portfolio, how much is the value? Trading and demand charges, mutual fund expenses. I have only 3 on the chart. Where is the 4th one? So the 2 portfolio values are there, mutual fund expenses are there, but the 4th one, which is trading and demand charges, just doesn't register in the chart. It is so little. 2.3% impact can be gauged not only with the bar chart, but with an alternative, with the option of buying stocks and noticing that it doesn't pinch you anywhere. I can't even register it in the chart. It's so little, roughly 2,000 rupees per annum. Now, where is the funds? Where do the funds become expensive? Gross return is about 17%. Let's say fees are about 3% or so, and net return is about 14%. Now, this is a yearly cost of a 10 lakh portfolio: 23,000 and 2,000. All right. If you take this same story over a 25-year period, 31 lakhs goes in mutual funds and only 52,000 in stocks. Impact of cost. If you put these costs in the fund, what happens? We try to correlate returns and costs. Do funds which charge you higher costs, do the returns go down or not? That would be a very nice example, very nice way of correlating. And this is exactly what has happened. If you see this, this is how the costs go up, and if you see how the returns go down. Just check. I'd mentioned that I'm going to come back to the issue of professional management, which I said is not such a strong reason by itself to buy funds. This is a 5-year return of 168 schemes which were there 5 years ago, as on 30th April 2015. This is a real life story of what actually can happen. Not this fund or that fund, but across the board what could happen to funds. Top 15 schemes gave you a return of 21%. All the schemes on an average, immediately the return drops to only 13%. The average of all the schemes. Bottom 15 schemes minus 5%. Same period. 5 years, 168 schemes. 168 schemes have 168 fund managers. And all of them are IITIM and all of that, you know. From top 168 jobs only. Okay, there are fund managers. Everybody wants to be a fund manager. All financial analysts want to manage money. That's the dream. And only 168 jobs in a nation of 1.25 billion people. And see the variation between them. All of them are owned by top quality companies, quality owners. You know, it could be, you know, foreign, Indian, doesn't matter. Could be JP Morgan, could be LIC Nomura. Nomura is a giant. One of those will be probably Nomura. Now, they're all the same, and you meet them, they're all very smart people. They know exactly what to do. They're fantastic with spreadsheets. Excel is like so easy for them. And yet, every time when I look at this variation, I ask myself, how is an average person going to believe if he has bought some of those by listening to X or Y? Because there are multiple ways one can get advice. You can get advice by somebody on TV, by reading, a friend, anything else other than your own hard work, right? So if somebody had bought any of those funds in this area, he'd never buy stocks in his life. So professional management is not something that I would pay too much of a premium on. Yes, I would pay premium for performance, which, as I said, go over 10 years or 7 years or so. Now, to take forward the way I've said choose your funds, 5 years ago, let's replay what we could have done. So 5 years ago, we have looked at these 5 stocks, and once through this choice, I'm going to move to from funds to stocks. 5 years ago, these were the top 5 funds. Okay, HDFC top 200. Sorry, 30%, 30%, 30% again, 29.98, and Birla Sunlife Frontline 28. Hardly much to choose from. They're all neck and neck. They're all fantastic companies, great. What do? We choose from this. Okay, but the problem is, you choose from this, you get the good and the bad as well. These funds over the next 5 years obviously won't do as well over every 5-year period, and they give you a return not bad still, but 12%, 12, 13%. 13%, and so on and so forth. So your choice was more or less not bad. It's not minus 5% category and so on. You got a fairly good return in a period which was, the market wasn't doing too well. Now, the problem is that these funds had all kinds of stocks. There were stocks in cyclical business. There was Reliance Industries in it. There was Jindal Steel and Power. All kinds of stocks were there in their portfolio. Let's look at what were these stocks. The top 5 funds. Look at the top stocks in these top 5 funds. These were the stocks. I have marked some of them in pink for a reason. 5 years ago, if somebody had asked me to choose from these are the ones that I would not choose. At any time, if you wake me up in the middle of the night and if you say Reliance Industries or State Bank, I would say no. No matter what my mental state is. Okay? These were the stocks in the portfolio 5 years ago. Now, let's look at the returns of all these stocks. I have 2 parameters over here. One is return on net worth, and that will give you an idea why I would not choose these stocks. That is how much return the company is making on our money which is invested with the companies. The second return is actually the market return, where the stocks were at that time, and 5 years where the stocks went. SBI gave a return of 3%. Reliance is actually down. Okay? And of course there is Jindal Steel and Jindal Stainless and BHEL and all of that. Clearly, all kinds of stocks were there in this portfolio, not just high quality stocks.
This return is for which 5-year period? This is for the
same.
Up to 2010.
Yeah.
5 to.
Yeah. Now, no. Those 30% return was from 2005 2010. When we are in 2010, we chose those 5 mutual funds. Those mutual funds had these stocks in 2005, and this is a return over that period. Mutual fund returns are 12%, 11%, and so on. These are the returns of the stocks in those funds. These are top stocks, almost covering 75%. So I took 75% by weight, by value for all of these funds, put them together. This is eliminated the common ones. This is what I got. Now, my question is, can we do better than this? And I'll give you a theoretical answer and a practical answer to this. Let's look at the top stocks once again. These are the ones which are there in the portfolio. Okay. And I picked the ones which I would like. And what would happen to my portfolio? This is quite dramatic. Average of top stocks in top funds. If you are, I don't know if you noticed this, notice the average figures below. In this entire period, Nifty itself has gone up 9.16%. And the average performance of this entire stock in the portfolio is 9%. These are the top stocks chosen by mutual funds, for which they're charging you 2% plus. So if you had bought Nifty, it's a beginner would have bought Nifty. He would not have to bother about choosing funds. He would not have to bother about choosing stocks. He would do as well as the average of this. Of course, the fund manager is a little more smarter, so that's why he got you 12% and 11% return more than the Nifty in two ways. Maybe invested a little more on the better performing stocks. It's a weightage that they give. This is equal weight. If you put same amount of money in all of this, this is the return what it would be. But net in 5 years, the top performing, the top stocks in the best performing funds, 9.16%, 9% return. Nifty is 9% return. Now, I was saying that I would not have chosen these, the pink ones, and the rest I would choose. Their choice, okay? I'm not even saying I will choose some other stocks. My universe, my sample is only their choice. I'm just eliminating ones that I don't like from their choice. That's all I've done. What would be the performance? It's quite dramatic. As I said, I repeat, average was 9%. Nifty was 9.6%. Average of the top 5 funds was 13%. And our portfolio, minus those pink ones which I don't want to choose only, is 17.74%. Significantly higher, 5 percentage points higher than somebody who's being paid crores of rupees to manage your money. Not bad. Now, you can always turn around and say, this is all hindsight. You know what performed, didn't perform, and you eliminated based on what you know. You didn't apply any method or anything, and you know Reliance has not performed. I don't trust you. Fine, don't trust me. This is what you have actually done. This is a cover story based on the same principle. Live example, not hindsight. Look at this. This is the formula applied in this cover story. The story came out in December 2013. Same process. Best stocks from best equity funds. You can go and pay 99 rupees only and read it on the website if you're not a subscriber. How have we done? This is a portfolio. It has done 39.5%. Everybody also has done fairly well in the last 1.5 years. So, top 35 schemes. But this method has beaten 92 of the 97 schemes which we had picked up. So it's possible. How is it possible? I'll show you. Funds charge us 2%, 2.5% and so on. According to me, they should do much better. If HDFC mutual fund is given 21% compounded annual return, they should have given 27% in my view. If they have done 12% in last 5 years, they should have done 17%, 18% in my view. At least 3 to 4 percentage points higher they should be giving, because they're charging me that money. Okay. Now, just go back to all that I'm saying. If you were just bought only the stocks that HDFC mutual fund has bought, same stocks, it's published every month, you can save that 2.3%. Straight away you can add that back to your portfolio, right? Because charges of demat is nothing. And today you can buy stocks for 20 rupees at Zerodha. So it's a negligible cost for somebody who is having 1 lakh portfolio also. 20 rupees is what? Vada pav. Okay. So you save that 2.3% straight away. So I'll pay you 2.3% for what? For 3 things. 1, for stock selection. Not for selecting Reliance, not for selecting BHEL, not for selecting State Bank of India of the world. For selecting a Lupin and a Dr. Reddy, well known, but you should know that these are expensive stocks, but they will go even higher. That is something that you should have known, right? 1. 2, if at all, for the crores of rupees that they're charging us every year, and the amount of money they are making on their own invested capital, it's 200-300% by the way for some of these funds, because to run a fund, it doesn't need that much of capital. And once the fund goes to a certain size, the incremental cost is nothing, and every month all this 2.2% business is coming in every month, irrespective of the performance. So I would expect them to get out of the market when it's expensive, get back in to the market when it's cheaper, or even within stocks, get out of certain stocks when they become expensive, like Symphony. I'm just giving an example. It just shot up, became 2,600. Now it's back 2,600, now back to 2,000 or so. I would expect them to get out of these stocks and get back in. So smart buying and selling is what I would pay for, most certainly. And that will add another 4-5 percentage points. If they tell you, we are not into buying and selling, there are two issues to it. A, they are lying, because funds keep churning the portfolio. There are some funds which is with an 88% churn in the portfolio. 88% of the stocks are new or fully changed within 1 year, whereas you are supposed to hold for the long term in their funds. And third thing, exposure weights. You should know, for instance, and that's why I'm paying you more money, that X stock will do better than Y. So you will buy more of X and less of Y. This is called weights. If you can't run an equal weighted portfolio, if you were to run an equal weighted portfolio, you will have over 30 stocks, 3.33% each. Only 50 stocks, 2% each. All right, but you have chosen to put 7.5% in something and 3.98% in something else. Yes.
Individual investor, I don't have the advantage of taxation which the mutual fund has.
Why?
No, because they can buy and sell and they don't get taxed.
I'm not asking you to buy and sell. I'm saying my paying money, a higher charge to them for an investor who's serious, who's interested in managing his own money carefully and smartly, for them to pay 2.3% to a fund manager, this would be the expectation. Let's see what they do on this score. Stock selection. Most funds have the similar kind of stocks in the portfolio. Why? Because they want to outperform the benchmark. What is a benchmark? According to SEBI, when you launch a new fund, you have to say what is your benchmark for the fund. You have to choose a publicly available index. Sometimes it's private index also, calculated. Like Reliance Entertainment Fund is benchmarked to an index which they've created. So you have to say, I want to be compared to Nifty, or I want to be compared to BSE 200 or whatever. So that is your benchmark. Once you do that, then the funds would go and buy most of the stocks in the benchmark, so as not to move too much away from the performance of the benchmark. If you move too far away, the salespeople will come and tell them, people are asking, how is it that Sensex has gone up 5% and you are down 2%? They don't want to take the chance even for a short period. Now, as many as 86 of the 200 actively managed diversified mutual funds have Reliance in the portfolio. One of the worst performing large cap stocks of the last 5 years. I would not buy this stock in any case. Forget about 5 years, 2 years, 10 years. Why do funds buy Reliance? Because Reliance is there in all benchmarks. So whether it's to 1% or 5% or 3%, they have to put the money in Reliance. It's like a compulsion. This is not stock selection. This is not finding out a great company that is going to grow over a period of time and give you great returns. This is playing safe with your money. And Reliance is down 21% in 6 years from May 2009. These two funds give you a great insight into how funds actually buy their stocks. HDFC Equity, HDFC Top 200. See the stocks in the two portfolios. It's the same. Identical stocks, the weights are only a little different. 37 stocks are common. 85% of the portfolio is common. 85%. 2 different schemes. This is not stock selection. The fund manager of one and the fund manager of other are just thinking alike, identically. And thinking in terms of all index stocks. Thinking in terms of State Bank, ICICI, Larsen Toubro, Infosys, Maruti, BPCL, Bharti, Tata Motors. All index stocks. You might as well buy Nifty and save that 2.3%. Evidence number 2. The performance of these 2 funds vis-a-vis BSE 200. This is called indexing, closet indexing, the disguised indexing. You are buying an index, but you are pretending that you are actively managing, and please pay me 2.3% and so on. So I proved my first point, that they cannot be demanding 2.3%, 2% from me for stock selection. The stock selection is nothing great to write about. I've already explained what I would have done, and I've proven it in a publicly available article, and now I've proven in the portfolio of HDFC just as an illustration. Point number 2, buying and selling. To create more long-term wealth, frequent buying and selling is not needed. There's no doubt about it. But what is definitely needed is to reduce your exposure to stocks once in whenever, 5 years, 10 years, when the market becomes very, very expensive. Market became expensive in December 2010. Market became expensive in January 2015. Market became expensive in January 2008. These are not with the benefit of hindsight. These, I can tell you exactly next when the market becomes expensive. It's still expensive now, according to me. This is the time, based on your research, you should be reducing your exposure to stocks, if you have not already reduced. But funds don't do that. Most of the funds are now 90% invested. For the last 5 months, market has been expensive. There's only one fund which has taken the trouble to trim its exposure. 2. One significantly, which is Quantum, and one ICICI fund, which is second. Funds don't do it. They don't even try to time. And by timing, I don't mean day trading. I don't mean trading over the week, month, or whatever. I mean occasional trimming of portfolio when you are very clear either the stock is outperformed or the market is overvalued. They don't even try to do any of this. Third, look at these 2 examples. I ask a question, I get very interesting answer. I asked Jason, do a comparison between State Bank of India and State Bank of India blue chip equity, and let's see what they did. I mean, nobody has to do anything to State Bank of India. It's a market-based thing. It's a stock. It fell. State Bank of India blue chip fund managers could have sidestepped this. We could have had a situation where it both falls, but it falls a little less or substantially less. It goes sideways somewhere. You move out of stocks. They are not able to do this. What more evidence do you need that even at a time in January 2008 when the market has become horribly undervalued, over the course of the next 3 months, the US economy, US financial markets were collapsing. Oil prices started falling after July. At no stage has the SBI blue chip equity fund manager been able to do significantly better than SBI, the stock itself, which went down sharply with the market, and so did the blue chip equity fund. Third, which is weights. So my first point was stock selection, second point was timing, occasional timing, third point is weights. There is absolutely no scientific basis for this kind of a look that you see in a portfolio. You go to value research, you will any portfolio anywhere you will see these weights, meaning these are the exposure. So 7.6% of the portfolio is exposed to State Bank of India equity. Why 7.6? Why not 5? Why not 3? Why not equal? Why not say I don't know how the stocks are going to perform in future? Nobody really knows. You can have a little more conviction about one stock or the other, but having picked a stock, how is it that you're sure that SBI it deserves a far greater exposure than, let's say, ITC or HDFC Bank?
See, can just say, here now I think the weight of SBI in Sensex is only about 3% or so, if I'm not mistaken. So here the fund manager has taken is an active call.
Right.
He has decided that so he is highly overweight in SBI. He is just at market weight in ITC. Now there is some thinking behind it. See,
what is the thinking behind the next one?
No, in the case of Reliance, you see Reliance weight in Sensex
5, 3, 2, 1. This is a toss of coin. I have done enormous research to find out how to weight a portfolio. Finally, it's your gut feel. There is no scientific basis for this. If there is no scientific basis, you should equal weight your portfolio.
No, you should be at market weight. If you don't go, if you are equal weighting.
If you selected stocks from index and if you have done a market weight, you will get a performance of the index minus 2%. Who's going to give you money for that and why? So in any case, then you have fallen foul of the first two conditions, which is A, stock selection, B, timing.
No, see the logic. For example, one fund manager, Prashant Jain, he once explained that he has gone for rate sensitive equity stocks, equity sectors. So there is some thinking behind it, which may be right or wrong. It may not turn out.
I'm sure there's thinking behind this. All I'm saying is that there is no published research to how to weigh a portfolio. I'm not talking about Prashant Jain. This is only an illustration. He may be right, he may be wrong. I have no doubt about the fact that sometimes he'll be right. But let's put it point blank. My selection of stocks, as I've explained, by eliminating companies on a simple criteria, and that is a well-known criteria. Everybody agrees you should buy high-quality stocks. By not buying a BPCL and a Reliance and a SBI, our stock portfolios perform so much better. And we do this every 2-3 years we do this. The same thing had happened earlier also, 2-3 years ago when we did this. So if the logic doesn't work, then you have to abandon that logic, first of all. More importantly, it's not about Prashant Jain. It is about an approach, a robust approach. The approach has to have a justification. It's not about how you apply it. Approach to picking stocks is very robust. You have to buy good quality stocks at reasonable price. You can define it the way you want to, but this approach is the correct approach. This is the approach from Warren Buffett down to everybody, whoever has bought stocks and made money in the long term. This is our approach. It has worked. It has worked for everybody. So there is enormous amount of data, information is available of what happens when you buy good quality stocks at a reasonable price. You can be 5% here or there, but no doubt that this is the correct approach. There is no information anywhere how to construct a portfolio with different weights. And this is not a simple thing. If SBI doesn't perform, and it has not performed so far, and if ICICI Bank doesn't perform, and Infosys is certainly not the best choice among the IT sector, and L&T doesn't perform, and then there is Reliance, and nobody knows what Tata Motors does in the rest of the world, which is what dictates its profitability. This is exactly the wrong portfolio to have. It doesn't have pharmaceutical companies at all anywhere. It doesn't have any other private bank. According to me, Kotak Mahindra Bank may do better than SBI.
Axis Bank and Pharma.
It's not there. FMCG is missing. Axis Bank is missing. Pharma is missing. You can say these are expensive. Yes, they are expensive. Asian Paints has always been expensive in its entire lifetime. It's never been cheap. Hindustan Lever is never cheap. They won't be cheap because they earn 40-50% return on capital. They are not like SBI, which has exposure to Kingfisher. What management? So this is a third reason why performance goes down. So I'm concluding point of my presentation, and after this I'll take questions. Buy stocks of high quality. It's as simple as that. You can pick them from the mutual funds portfolio itself. You can ask me how to pick stocks, and there are 6,000 companies and there are 300 companies. Share your database with me. None of that is not needed. Take top 5 or 6 of these funds. UTI is a very good fund. UTI equity fund. Anything that Anup Bhaskar handles, good. Anything that Prashant Jain handles, good. Anything, some of the Reliance funds are good. ICICI funds are good. Take all of them, all the stocks in one place, in one Excel sheet. Find out against them what is the return on capital employed. Choose the top 20. You're not going to go wrong. You're going to beat the fund managers. I'm quite certain about it. I have done it. You can do it too. There's no doubt about that. And the cost is nothing, which is your demat charges and buying one time. All right. As for selling, the National Stock Exchange publishes a PE of the whole market, price to earnings ratio. It's based on last 4 quarters of profits. If the PE is above 23, 24, the market is expensive. If the market is expensive, think of bringing down stocks that have gone up a bit. Okay. Remember, it's all a game of probability and approximation. Our whole approach should not be to maximize. Our whole approach should be to be satisfied that A, we have got tax-free gains, which is far higher than bank interest. B, we would have beaten 60 to 70% of the fund managers in any case. So last extra bit of money you haven't got, you sold early, the stock has gone up, train your mind to be happy. In any case, that is, you know that it's all about probability and approximation, as I mentioned, and nothing more is needed. For your inspiration, one chart, one last thing. This is a chart of a stock. If you had put 1 lakh in it, in 1990, it would have become 1.25 crore. You can see that over there. It has fallen a little bit. Why has it fallen? I'm sure all of you can guess. Because of a controversy which might sink the company. Maggie. This is Nestle. You can't even see what the problem is, and it has gone through everything. It's gone through, Rajiv Gandhi's assassination, and Babri Masjid, and India going bankrupt, and 13% inflation, and .com crash, and 2008 crash, and everything. It's gone through coalition government, 20 scams, all through that. This is how the stock has risen. Thank you very much.